If you dream of making money from the stock market but don't know where to start, then this audiobook summary can change your life. Today we've brought you How to Day Trade for a Living, a book that will tell you how to consistently earn profits from trading right from your home without quitting your job. The author of this book, Andrew Aziz, is a professional trader, best-selling author, and financial market expert who taught himself to earn a full-time income from day trading after quitting his own job, and has helped thousands of others follow the same path. If you think trading is just a game of luck, then after listening to this summary, your perception will change. You'll learn how big traders control the market, where common traders make mistakes, and how to avoid those traps. Which strategies actually work, and which ones can only make you poor. Every point will surprise you, every line will teach you something new. So, if you truly want to make money from trading, don't forget to listen to this summary till the end, because this might just be the knowledge that becomes the key to your financial freedom. Let's start. 1. The real game of day trading. When people hear day trading, they often picture someone sitting in front of a fast computer screen, staring at red and green charts, and making thousands of rupees in just a few minutes. But the reality is very different. The real secret of the market is that day trading in the stock market isn't a science, but an art. It's more a game of psychology than mathematics or equations. Professional traders who make a profit every day know the unspoken rules of this market, rules that 95% of people can't even imagine. Now the question arises, what are these secrets that allow 5% of traders to consistently make money while the rest go into losses? 2. The invisible forces in the market. If you think that prices in the market only rise and fall based on demand and supply, then you're only seeing the surface truth. In reality, the market is controlled by big players, also known as smart money. These are large institutional investors and high-frequency trading (HFT) firms that push retail traders out of the game. How big players deceive small traders. When there's a strong bullish breakout in a stock, retail traders quickly start buying. But in the very next moment, the market starts moving in the opposite direction, and they end up in losses. This is actually a false breakout trap that big players create to ensnare retail traders. They first buy large quantities of the stock, driving the price up. Then, as soon as common people enter, they sell their shares, book their profits, and the price falls. How to avoid this trap? Whenever there's a breakout, don't buy immediately. First, look at the volume and candlestick patterns. If the price starts falling immediately after a breakout, understand that it's a trap. Wait for the price to retest and go in the correct direction. 3. Hidden tricks of pro traders. To become a successful day trader, you have to think like the big players. Let's understand some of their rules. A. Liquidity grab, the market's biggest trick. Have you ever noticed that when you take a trade, the market suddenly hits your stop loss and then moves back in your favor? This isn't a coincidence, it's a strategy called liquidity grab that professional traders use. Big players hit the stop losses of small traders to get their own entry. How to avoid? Don't place your stop loss directly on support and resistance levels. Always keep it a little further away. Where more people place their stop losses, the chances of becoming prey in the market increase. 4. The most secret strategy. How to identify smart money footprint. Whenever a big player enters, they always leave signals, which we call smart money footprint. To identify this, you need to look for a few specific things. A. Unnatural volume spike. If a stock suddenly moves with very large volume L, it could mean that smart money is entering it. Pay attention to such movements and see how the next few candles form. B. Wick manipulation. Large wicks mean there's uncertainty in the market. If a candle forms with a very large wick, it could mean that smart money is accumulating liquidity there. How to take advantage of this? When you see a stock's movement is abnormal and its volume is increasing, wait for the next candle. Enter in the direction that smart money goes. 5. Trading psychology, the biggest secret to success. Ultimately, what differentiates a successful trader from an unsuccessful one is their mentality, their trading psychology. A. Pain threshold, the difference between professionals and novices. Novice traders get scared and exit with a small loss. Professionals understand the pain threshold and wait for the right opportunity in the market. B. Impulse trading, the most dangerous enemy. Whenever you take a trade without thinking, simply out of fear or greed, traders get trapped. Stop yourself from taking such trades. If the market doesn't go in your direction, learn to exit. Conclusion: if you want to make money, remember 3 things. 1. The market is not against you, but your thinking defeats you. Many losing traders often think, the market is always against me. As soon as I buy, the market falls. But the market is never against you. It's your own wrong thinking and emotions that defeat you. Novice traders feel that they can beat the market. But the truth is, you don't need to beat the market. You need to understand the market's moves. If you think like the big players, you'll be able to make money. Now let's understand the mistakes most people make, which cause them to lose money. 2. Most people think about winning first, not about not losing. 95% of traders' thinking is in the wrong direction. Before taking a trade, they think about how much profit they can make from this trade. But professionals first think, if this trade goes wrong, how much will I lose? In the market, first learn to defend yourself, then attack. First, decide where your stop loss will be and whether the risk-reward is correct or not. If a stop loss and target are not set, this trade will prove to be a loss for you. How to avoid? Always calculate the risk first, then think about profit. If a trade offers you a good profit with a small risk, only then enter it. 3. Impulse trading is the biggest enemy. Many novice traders see some candlesticks and take a trade without thinking. They think the market will go up now, but within moments it falls in the opposite direction and their stop loss is hit. Then, they get angry and start revenge trading, leading to even more losses. How to avoid? Before taking every trade, ask yourself 3 questions. What is my risk reward in this trade? What is this trade based on? Don't just have an "it feels like" thought. If this trade goes wrong, what will be my next step? 4. Big traders prey on your emotions. Avoid emotions, or you'll lose money. If you are trading out of fear, greed, overconfidence or anger, you are going to fall into the trap of big traders. How big players take advantage of your emotions. When a stock suddenly goes up very fast, new traders usually buy out of greed. But this trade is just a trap where big traders are ensnaring small traders. As soon as small traders buy, big traders sell their positions and exit, and the market starts falling. How to avoid? Never trade swept away by emotions. When you feel like you should buy a stock, stop, think again, and risk assess the trade. Document every trade. This will help you correct your mistakes. 5. Ignoring stop loss is the biggest reason for losing money. Most traders are lazy about placing a stop loss, or they ignore it. They think that placing a stop loss will close their position, so they don't bother. Control your emotions, or big traders will loot you. Never ignore a stop loss. Overtrading can destroy you. Take high-quality trades. If you correct these mistakes, you can consistently make a profit in day trading. Remember these 5 points: risk assessment, avoiding impulse trades, understanding market psychology, recognizing smart money footprints, and never ignoring your stop loss. Day trading isn't just about making money, it's about making a consistent profit. Be patient, don't rush, and wait for the right opportunity. Day trading for a living is an aspiration for many, promising financial independence and flexibility. However, it's a demanding profession that requires significant knowledge, discipline, capital, and emotional control. It's crucial to approach it with realistic expectations, understanding that a vast majority of aspiring day traders do not succeed. This comprehensive guide will explain the intricacies of day trading and outline the steps and considerations for those aiming to make it their full-time occupation. 1. Understanding day trading and its nature. Day trading involves buying and selling financial instruments within the same trading day, aiming to profit from small price fluctuations. Unlike long-term investing, day traders do not hold positions overnight, thus eliminating overnight market risk. The objective is to capitalize on intraday volatility, making numerous small profits that accumulate over time. This high-frequency, short-term approach demands constant attention to market movements and rapid decision-making. 2. Essential prerequisites and foundational knowledge. Before embarking on day trading, a solid understanding of financial markets is paramount. This includes grasping how stock markets operate, how prices are determined, and how to interpret various financial charts and indicators. Familiarity with fundamental and technical analysis, even if not used extensively in day trading, provides a broader market context. Aspiring traders must also comprehend basic economic principles and how global events can influence market sentiment. 3. Choosing the right broker and platform. Selecting a reliable and cost-effective brokerage firm is a critical first step. In India, numerous SEBI-registered brokers like Zerodha, Upstocks, Angel One, and ICICI Direct offer robust trading platforms. Key factors to consider include low brokerage fees, fast execution speeds, user-friendly interface, availability of advanced charting tools, and responsive customer support. A good platform can significantly impact a day trader's efficiency and profitability. 4. The importance of a demo account and paper trading. Before risking real capital, it is imperative to practice with a demo account, also known as paper trading. Most brokers provide these simulated environments where traders can execute trades with virtual money under real market conditions. This allows beginners to test strategies, familiarize themselves with the platform, understand market dynamics, and build confidence without incurring actual financial losses. It's a crucial learning phase where mistakes can be made safely. 5. Developing a robust trading strategy. A well-defined trading strategy is the backbone of successful day trading. This involves outlining specific entry and exit rules, risk tolerance, profit targets, and the types of instruments to trade. Common day trading strategies include scalping, profiting from tiny price changes, momentum trading, riding strong price trends, breakout trading, entering when prices move beyond resistance/support, and gap trading, exploiting price gaps at market open. A strategy doesn't need to be right all the time, but the wins should outweigh the losses. 6. Understanding and implementing risk management. Risk management is arguably the most vital aspect of day trading. It involves techniques to preserve capital and limit potential losses. Key practices include setting stop-loss orders to automatically exit a trade if it moves against your position, determining appropriate position sizing, the amount of capital risked per trade, and avoiding highly volatile or illiquid stocks. Never risk more than a small percentage, e.g., 1 to 2% of your total trading capital on any single trade. 7. The psychology of day trading. Emotional control is as critical as technical skill in day trading. Greed and fear are powerful emotions that can lead to impulsive decisions and significant losses. Successful day traders maintain discipline, stick to their trading plan, and avoid revenge trading, trying to immediately recoup losses. Developing a stoic mindset, accepting losses as part of the game, and focusing on process over outcome are essential for long-term success. 8. Capital requirements and financial viability. While there's no strict minimum capital to start trading in India, you can even begin with a few hundred or thousand rupees. Day trading for a living requires substantial capital. This is because profits are often a small percentage of the capital deployed. To generate a sustainable income, a larger capital base is needed to absorb inevitable losses and allow for meaningful profit accumulation. Experts often suggest having at least 5 rupees 10 lakhs or even more, depending on desired income, dedicated to day trading to withstand drawdowns and generate a living wage. 9. Choosing liquid assets and instruments. Day traders primarily focus on highly liquid stocks, indices, or commodities. Liquidity ensures that orders can be executed quickly at desired prices without significant price impact. Illiquid assets can lead to wider bid-ask spreads and difficulty in entering or exiting positions, which is detrimental to a day trader's rapid execution needs. Focusing on a select few liquid instruments allows for deeper understanding and better prediction of their price movements. 10. Market analysis and continuous learning. Successful day traders engage in continuous market analysis, adapting to changing market conditions. This involves regularly reviewing economic data, news events, and sector-specific developments. Post-trade analysis or journaling is crucial for identifying patterns in one's own trading, understanding what worked and what didn't, and refining strategies over time. The market is dynamic, and a trader's learning journey should never end. 11. Realistic expectations for profitability. It's vital to set realistic expectations about potential earnings. Day trading is not a get-rich-quick scheme. Many aspiring traders fail, and even successful traders aim for consistent small gains rather than massive overnight profits. A realistic daily profit target might be 1% of the account size, but even this can be challenging to achieve consistently. Initial periods will likely involve losses and a steep learning curve. 12. The importance of a trading plan and journaling. A detailed trading plan acts as a roadmap outlining entry/exit criteria, risk limits, and daily goals. Adhering to this plan prevents emotional trading. A trading journal is equally important, serving as a record of every trade, including the rationale, outcome, emotions, and lessons learned. This data provides invaluable insights for self-correction and continuous improvement. 13. Regulatory compliance and taxation. In India, day trading is regulated by SEBI. Traders must be aware of rules regarding minimum margin requirements, short selling regulations, naked short selling is prohibited, and the use of intraday profits cannot be used for further trading on the same day, typically available after T+2 settlement. Understanding tax implications on capital gains from day trading is also crucial for financial planning. 14. Building a support system and managing stress. Day trading can be an isolating and highly stressful profession. Building a network of fellow traders or mentors can provide support, shared insights, and accountability. Maintaining a healthy work-life balance, incorporating stress-reducing activities, and ensuring adequate rest are crucial for long-term mental and emotional well-being, which directly impacts trading performance. 15. Dedication, patience, and persistence. Ultimately, day trading for a living is a marathon, not a sprint. It demands immense dedication, patience, and persistence. There will be losing days, weeks, and even months. The ability to learn from mistakes, adapt strategies, and remain disciplined through challenging periods is what distinguishes successful day traders from those who give up. It's a continuous journey of self-improvement and market adaptation. Big players create panic to trap people in greed. Then, they book huge profits. If the market suddenly moves a lot without any news, it could be a trap. How to avoid this? Always analyze volume and price action together. Analyze FII data and option chain to understand where big players are building positions. How to avoid getting trapped? Look at the chart instead of the news and pay attention to volume and option data. If there's overwhelmingly positive or negative news, check the market's actual trend. Understand institutional trading patterns and the direction big players are moving. Big players exploit news. Big trades never exit at round numbers like 100, 200, or 500. They always buy and sell at smart levels where regular folks don't pay attention. For example, if a stock breaks 500 rupees resistance, small traders buy it. But big players exit at 505 or 510 rupees because that's where their orders are. How to know this? Find the stock's correct support and resistance levels from option data. Track big players' VW, a P-volume weighted average price levels. How big players execute? Stop loss hunting. You've probably seen your stop loss hit and then the market moves in your direction. This happens because big players intentionally trigger stop losses. How they do it? They place large VWAP orders to break support and resistance. Small traders' stop losses get hit and big players exit. Then the market immediately reverses and big players enter. How to avoid this? Always place your stop loss outside the volume zone. Never place your stop loss at psychological levels like 100 rupees, 200 rupees, or 500 rupees. Conclusion: how to exit the market correctly and increase your profits? Understand the exit strategy of big players. They sell in silence and buy in whispers. Identify bull and bear traps. Follow the market's moving trend not media hype. To avoid wrong exits, pay attention to FII data, option chain, and volume trends. To avoid stop-loss hunting, set your stop-loss at smart levels. If you adopt these hidden strategies, you can not only avoid wrong exits, but also increase your profits. Point 5. How to create a true edge in trading that big players don't want you to know. Why 99% of traders fail and how that 1% wins. Do you know that 99% of retail traders consistently lose money, but that same money goes into the accounts of 1% smart traders? Big players want you to trade emotionally, enter and exit at the wrong time, and give up quickly. 3 big mistakes of failing traders. They don't understand the edge of their strategy. They trade with the crowds. When everyone is buying, they buy too. They trade with their emotions, fear, greed, and incomplete information. Now the question: what do those 1% successful traders do differently? They create their edge in the market. The true meaning of edge. What makes you unique in the market? What does edge mean in trading? Many people think edge just means a strategy, but the true meaning of edge is your own unique advantage that sets you apart from others. 3 hidden ways professionals create their edge. They master one trading style: swing, scalping, or positional. They trade against the crowd. When everyone is selling in a panic, they are buying. They understand long-term data and market behavior. They treat trading like a science, not emotions. How to create your edge? Focus on one strategy and master it. Understand market structure and price action instead of just indicators. Track the behavior of big players, how and when they build positions. 3 hidden strategies of big players and how to learn from them to create your own edge. 1. The secret of volume and price movement. Big players never directly show their true intentions. They slowly build their positions so no one suspects. When they buy a stock, its price slowly increases. There's no sharp move. When they sell a stock, they slowly distribute it. How to identify? If a stock is slowly increasing without any news, it could be that big players are buying. But if a stock is suddenly moving up very fast, but the volume isn't high, it could be a trap. Your edge. Understand volume plus price action. If a stock is consistently making higher highs and higher lows, big players are still buying. But if a stock is making lower highs and lower lows, it's a sign of selling. 2. Trading against the crowd in the market. Have you noticed? When everyone recommends buying a stock, it starts to fall. The reason for this is contrarian trading strategy. Big players always trade against the crowd. 8% and 78% levels. These levels always form the base of big moves. Open interest data. Where more positions are built, there will be big moves. How to create your edge? Combine VWAP and Fibonacci levels for trading. If there's large open interest at a level, there will be a breakout or breakdown there. 3. Mastering trading psychology. 90% of trading depends on psychology and only 10% on strategy. Big players play with your psychology and trap you in trading. How they manipulate your psychology? They create fake breakouts and breakdowns so people trade in the wrong direction. They use news to increase fear and greed. They move the market frequently intraday so you hit your stop loss quickly. How to avoid this? Create a no-trade zone. Don't trade all the time, focus only on quality setups. Adopt reverse trading psychology. When everyone is selling in a panic, think that this could be a buying opportunity. Develop emotional discipline. Don't take any trade personally. Focus only on data. Conclusion: how to actually create an edge and trade like professionals. Understand the strategies of big players. They play against the crowd. Strengthen your psychology. The market wants to defeat you by making you emotional. Master price action and volume. This will help you identify fake moves. Only trade on strategies that have been back-tested. Jumping into the market without testing is suicide. If you understand these hidden secrets, you won't just trade. You'll play with an edge in the market and win. Point 4. Big players trade management strategy. How small traders are defeated in the market. Taking a trade is easy, but managing it correctly is the real game. There are 2 ways to make money in trading. Either let your winning trades run long or cut losing trades quickly. Andrew Aziz's How to Day Trade for a Living is a comprehensive guide for aspiring day traders, aiming to equip them with the knowledge, strategies, and psychological fortitude needed to succeed in the fast-paced world of intraday trading. The book emphasizes that day trading is not a get-rich-quick scheme, but a serious profession requiring dedication, practice, and a disciplined approach. Here's a summary of its key concepts. 1. The reality of day trading. It's a serious business. Aziz stresses that day trading is not gambling or a hobby. It requires a professional mindset, akin to running a business. Competition with pros. New traders are competing against highly skilled, well-equipped professional traders. To win, you need to be significantly better than average. Lifestyle benefits, but not instant. While day trading offers freedom and flexibility, it's not an immediate path to riches. Success comes with consistent effort and learning. 2. Core pillars of successful day trading. Aziz highlights 3 crucial skills. Market analysis. The ability to understand the power dynamics between buyers and sellers and bet on the winning group. This involves analyzing charts, price action, and volume. Money and trade management. Knowing how much to risk on each trade, when to exit, both for profit and to cut losses, and managing your overall account effectively. Psychological discipline. Embracing self-discipline, avoiding emotional decisions, fear, greed, and maintaining a winning attitude regardless of market fluctuations. 3. Essential knowledge and tools. Fundamentals of day trading. The book covers the basics of what day trading entails, how it differs from other investment styles, and the risks and rewards involved. Trading tools and platforms. It discusses the important software and technologies such as charting software, trading platforms and data feeds, and how to use them effectively. Understanding stocks in play. Identifying stocks that are experiencing significant price movement, often due to news or earnings reports, as these offer the best trading opportunities. 4. Key day trading strategies. Aziz outlines several popular day trading strategies, emphasizing that these are not rigid algorithms, but rather tactical approaches that require a gut sense developed through practice. Some common strategies discussed include ABCD pattern trading. Identifying a strong upward move, a pullback, and then a continuation of the trend. Bull flag momentum trading. Recognizing a short consolidation after a strong upward move, signaling a continuation. Top reversal and bottom reversal trading. Identifying key turning points in a trend. Moving average trend trading. Using moving averages to identify and follow trends. VWAP, volume weighted average price trading. Utilizing VWAP as a dynamic support resistance level and an indicator of institutional activity. Support and resistance trading. Identifying key price levels where buying or selling pressure is expected to be strong. 5. Risk management and psychology. Risk management is paramount. The book heavily emphasizes setting proper stop losses, defining your risk per trade, and protecting your capital. Psychological traps. Aziz explains how market dynamics and even big players can manipulate a trader's psychology through fake breakouts, news-driven hype, and rapid intraday moves. Counterintuitive trading. The book often promotes a contrarian view, understanding when to trade against the crowd, and recognize panic selling as a potential buying opportunity. Developing a trading plan. The importance of having a pre-market routine and a detailed trading plan with contingencies for different market scenarios. 6. Practice and continuous learning. Simulator trading. The book encourages extensive practice in a simulated trading environment before risking real capital. Journaling and review. The importance of keeping a trading journal to track trades, analyze mistakes, and learn from experience. Community and mentorship. Andrew Aziz is also the founder of Bear Bull Traders, an online community, and the book subtly encourages the idea of learning from experienced traders. In essence, How to Day Trade for a Living provides a practical, no-nonsense approach to day trading, focusing on building a strong foundation in market understanding, strategic execution, risk management, and psychological resilience. It demystifies day trading, making it accessible to beginners while offering valuable insights for more experienced traders looking to refine their skills. Risk management is the cornerstone of sustainable trading success. It's the process of identifying, assessing, and controlling the financial risks associated with your trading activities. While the allure of big profits often dominates discussions in trading, the reality is that without effective risk management, even a string of winning trades can be wiped out by a few large losses. Here's a breakdown of why risk management is critical and the key strategies involved. Why is risk management so important? 1. Capital preservation. This is the primary goal. Your trading capital is your business, and without it, you can't trade. Risk management helps prevent catastrophic losses that could wipe out your account. 2. Minimizing losses. Trading involves inherent uncertainty. Losses are inevitable. Risk management helps you limit the size of those losses, ensuring they don't spiral out of control. 3. Emotional control. A well-defined risk management plan reduces the emotional burden of trading. When you know your maximum acceptable loss per trade, you're less likely to make impulsive decisions driven by fear, cutting winners too early, or greed, holding on to losers too long. 4. Sustainable trading. By controlling risk, you ensure that even if you have a series of losing trades, you still have enough capital to continue trading and capitalize on future opportunities. It allows for consistency in your trading journey. 5. Informed decision making. Risk management forces you to think about the downside of a trade before you even enter it. This leads to more disciplined and logical trading decisions. 6. Surviving volatility. Markets are dynamic and can be unpredictable. Risk management helps you weather unexpected price swings, news events, or black swan events that could otherwise decimate your portfolio. Key risk management strategies and techniques. 1. Define your risk tolerance. Before you even place a trade, understand how much you are comfortable losing on a single trade or over a day per week. This will influence your position sizing. Many traders follow the 1% rule or similar, like 0.5% or 2%, meaning they risk no more than 1% of their total trading capital on any single trade. For example, if you have a 100,000 rupees account, you'd risk a maximum of 1,000 rupees per trade. 2. Position sizing. This is crucial for controlling your risk per trade. It's the process of determining how many shares, contracts, or units of a financial instrument to buy or sell based on your risk tolerance and the distance to your stop loss. Formula. Simplified. Number of units equals risk per trade in rupee, distance from entry to stop loss in rupee. 3. Stop loss orders SL. A predetermined price level at which you will automatically exit a losing trade to limit your downside. Always place your stop loss before entering a trade. Types. Hard stop loss, a fixed price level. Trailing stop loss. Adjusts as the price moves in your favor, helping to lock in profits while still protecting against reversals. Avoid psychological levels. As mentioned in Andrew Aziz's summary, avoid setting stops at round numbers, e.g. 100 rupees, 500 rupees, where many traders might place them, making them prone to stop-loss hunting by larger players. 4. Take profit orders, TP, price targets. A predetermined price level at which you will automatically exit a winning trade to secure profits. This helps prevent greed from taking over and turning a winning trade into a losing one if the market reverses. 5. Risk-reward ratio. Before entering a trade, calculate the potential profit versus the potential loss. A common target is a minimum 1:2 or 1:3 risk-reward ratio, meaning you aim to make at least 2 or 3 times what you risk. Example, if you risk 100 rupees, you aim for a profit of at least 200 rupees or 300 rupees. This ratio allows you to be profitable even if your win rate is less than 50%. 6. Trading plan. Develop a comprehensive trading plan that outlines your entry criteria, exit strategies, stop loss, take profit, position sizing rules, and market analysis techniques. Stick to your plan rigorously to avoid emotional, impulsive decisions. 7. Diversification. For longer-term portfolios, but principles apply. While more relevant for investing than day trading, the principle of not putting all your eggs in one basket is important. In day trading, this can mean not over-concentrating on a single stock or sector, especially if you hold multiple intraday positions. 8. Avoid overtrading. Resist the urge to trade constantly. Only take high-probability setups that align with your trading plan. Overtrading leads to increased commissions and exposure to unnecessary risk. 9. Continuous learning and backtesting. Regularly review your trades, learn from your mistakes, and refine your strategies. Backtest your strategies on historical data to understand their profitability and risk characteristics before applying them with real money. 10. Emotional discipline. Recognize and manage emotions like fear, greed, revenge, and overconfidence. These are the biggest enemies of consistent profitability. If you're having a bad day, it's often best to step away from the market. By diligently implementing these risk management principles, traders can significantly increase their chances of long-term survival and profitability in the dynamic world of financial markets. It's about playing defense as much as, if not more than, offense.